Hi folks, welcome back to Murthy Finance Academy and let us start. So today we're taking a close look at Garware Hi-Tech Films. Now the market's been buzzing about their latest quarterly results, and not in a good way, mostly because of that headline revenue number. But our analysis suggests there's a much bigger story playing out here, a story about some pretty major structural changes that the market might be missing entirely. You see, on the surface, that latest report does look a bit concerning, and it really boils down to one big question. Why did revenues suddenly fall off a cliff? Is this just a temporary speed bump, a cyclical thing, or is it something more serious, maybe the start of a real structural problem? That's exactly what we're going to unpack. And here's the number that really got everyone's attention, minus 19.5%. That's the drop in revenue from just one quarter to the next. I mean, when you see a number like that in isolation, it's pretty jarring, right? It absolutely demands an explanation, because that's the kind of thing that can really shake investor confidence if you don't understand the context behind it. All right, so here's how we're going to break this down. First, we'll look at those confusing quarterly numbers. Then, we'll peel back the layers to see what's really going on. After that, we'll get into their strategic reroute, what management is actually doing about it. We'll also cover what the market might be missing, the potential risks that could break this thesis, and finally, a framework you can use to monitor the situation yourself. Okay, let's dive into section 1, the confusing quarterly numbers. First things first, we need to get the facts straight and look at the headline data that's causing all this concern. So here's the financial snapshot for Q3. Revenue came in at 459 crores, but here's where it gets interesting. Look at the divergence here. Year over year, so compared to the same quarter last year, things are almost flat, down just 1.6%. But when you compare it to the previous quarter, you see that huge 19.5% drop. And that right there, that discrepancy is exactly what's making the market so nervous. This really paints a clear picture. On one side, you have a stable quarter from last year, and on the other, this recent sharp dip. It really is a tale of two quarters, and it brings us right back to that key question. What on earth drove this change? And more importantly, is it just a temporary blip, or is it a sign of something deeper going on? All right, so that's the what. Now let's get into the why. It's time to peel back the layers and look past the headline numbers to see what's really driving this performance. And the first clue comes straight from management. They pointed out that the scenario for Q3 is always different because it's seasonally low. Every year, Q3 is like that. And this makes sense, right? Q3 covers that October to December period, which is historically a slow time for them. This isn't some new, shocking development. It's a predictable part of their business cycle, usually tied to things like holiday slowdowns and customer budget cycles in their big export markets like North America and Europe. The next layer of this story is where their money comes from. A huge chunk, almost 75% of their revenue comes from exports. When you're that dependent on international markets, you're naturally exposed to all the big global forces out there, for better or for worse. So the key takeaway here is that it's not just about seasonality. You've got to layer on these cyclical headwinds. Garware is navigating a really complex global landscape. We're talking tariffs, we're talking geopolitical situations, and just general shifts in global demand. These are the kinds of temporary cyclical pressures you just have to manage when you're a major global exporter. Okay, but here's where the story takes a really interesting turn. Management isn't just sitting around waiting for these headwinds to blow over. No, they're actively reshaping the business. They're making a strategic reroute. And I think the best way to think about this isn't some kind of crazy high-risk pivot like a startup would do. It's more like an old manufacturing house learning new tricks. This is a well-established company, and they're very deliberately evolving their business model. They're using what they're already great at, manufacturing, to build out new and hopefully higher-margin businesses. And you can actually see this strategy in action on this timeline. Back in 2022, they jumped into the paint protection film or PPF market. Just this year, they doubled their capacity for it. But the real game changer, the critical milestone, is coming up in October 2026. That's when they're commissioning their very own TPU extrusion line. And believe me, this is a huge deal for their overall strategy. So what exactly is this TPU line, and why does it matter so much? Well, TPU is the key raw material for these high-margin films they're making. By building their own line, they complete their vertical integration. They're basically creating what they call a chips-to-film model. This means they'll control the entire process, from the raw materials all the way to the finished product. And in today's world of crazy supply chains and tariffs, this isn't just about saving money. It's like an insurance policy. It gives them a massive competitive advantage, a real moat around their business. And this all brings us to what the market might be missing. It feels like there's a real disconnect here. The market seems to be fixated on one bad quarter, just one noisy data point. But when you dig in, you see this fundamental shift, a much deeper story, happening right under the surface. Let's break it down. The market's view seems to be pretty simple. They see soft Q3 results, they're worried about tariffs, and they basically see Garware as a traditional manufacturer. But the deeper reality is way more forward-looking. They're making strategic investments in high-growth PPF, they're building a brand through a direct-to-consumer model, and they're creating that powerful moat with vertical integration. It's a completely different story. But look, no strategy is risk-free. A good analysis has to look at what could go wrong. So let's talk about the potential signals that could actually break this whole thesis. Here are the early warning signs you've got to watch for. First, if their growth continues to slow down and you can't blame it on seasonality anymore, that's a big red flag. Second, if their profit margins actually get worse after that big TPU line comes online, that would seriously question the whole strategy. Third, if they just can't get any real traction with their direct-to-consumer business. Also, keep an eye on how they're spending their money. If their priorities suddenly shift, that's a signal. And finally, if their cash position gets tight and they can't fund these big plans, that would obviously be a problem. So, how do we wrap all this up? Let's build a simple framework for monitoring this. How can you actually track this evolution and see if they're staying on course? Here are the key metrics you'll want to watch. First, how fast are those new home solutions and D2C sales ramping up? Second, what percentage of their total sales is coming from architectural films? Is that slice of the pie getting bigger? Third, and this is the big one, what happens to their margins after that TPU line is up and running? And finally, are they managing to diversify their exports away from just the US market? So at the end of the day, it really all boils down to this one question. Is this a story of temporary pain for long-term gain? Or is this weak quarter the first sign of a real structural decline? The framework we just laid out should give you the tools to monitor that question for yourself as this whole story unfolds. Thanks for tuning in. If you like the video, please like, share, and subscribe. Disclaimer, I am not a CB-registered research analyst. All stocks discussed in this video are purely for educational purposes only. Do not consider it as buy or sell recommendation. Do your own research or consult a financial advisor.